All right, Colin, we are back with another episode of What Just Happened. You've done a little bit of research this morning. Tell us what's going on and where we are.
Yeah, it was an interesting week. Markets are down, but with that being said, I think the reason why the markets are down are kind of interesting if you actually think about it. So, some interesting news came out this week, which is basically surrounding expectations on GDP growth. If we look at GDP growth, they basically are saying now that they're expecting it to be better than what was originally revised. So, estimates basically had it at 3.3%, but it actually came in at 3.8. So most people think, well, why would that actually cause the market to go down? Well, because the last time we did one of these, we were talking about Fed interest rates. And the reason why Fed was projecting to do interest rate cuts was because of GDP growth and it being lower than expected. Now that it's coming in higher than expected, it's possible that expectations around Fed interest rates aren't going to be, I'll say, as positive. So it's possible that they may not cut as much as expected. And if that's the case, then that was already priced into the market. So that's going to cause a bit of a pullback here, and that's exactly what we've seen this week.
Yeah, it's interesting that you have the chart that we have on the screen here, which is basically just showing the S&P 500 over the last, well, just this week to date, right? And it's down 1.3%, and we're like, why is the market down, right? Which is funny because when you have a little bit of perspective, you see it's still more than 12% positive this year. Over the last 1 year, you're 15%. Over the last 10 years, you're doing pretty good, right? We're always trying to explain short-term moves, when sometimes it's retrospect. I feel like we're climbing the wall of worry right now. And any excuse for us to slow down in market performance seems to be one that people want to take advantage of.
Yeah, and I think, an interesting question here is if we're in something called, a bad news bias here.
Mm.
I think there's a lot of people here looking for some bad news. And with that being said, it is this week maybe some not positive news while GDP is up and the economy might be a little bit stronger than anticipated. What this does mean is that, the Fed cuts may not come, I'll say, as soon as what people were hoping. Jobless rates came in this week as well, and those were a little bit better than expected. With that being said, the economy is looking pretty good, but when you have multiple interest rate cuts already priced in, the market will probably pull back from that. So the question becomes is, what are we going to do from here? Is the Fed actually going to cut as much as the guidance that they gave a few weeks ago? And really, what does the rest of the year hold? Which, I think is kind of up in the air at the moment with what the Fed's actually going to do, but we'll just have to see how future numbers come in.
But doesn't it seem like maybe, this is good news, right? The economy is stronger than expected. It's certainly slowed down and we're not, firing in all cylinders, but most cylinders are still working, right? And,
Yeah.
if we get better employment numbers, that's not a bad thing. So, should the market go up because interest rates might go down, or should the market go up because the economy is strong?
That's the $1 million question right now. It's funny because I think you could look at it from either direction. It's like you have good news, which gives bad results, and then sometimes you have bad news, which will give a good result. And I think people are really, really focusing on the Fed right now. And I think that's what this chart is really showing us is, when people have expectations that the Fed's going to cut, that's really driving a lot of the market, which is surprising. I mean, just some numbers can come out in a week that can make a big impact on this because the whole thing is anticipation of cuts. But when you zoom out and then you look at a chart like this, I mean, man, what an awesome chart.
What a
If we
great
could
run.
yeah, I mean, if we could rewind time, I would have been buying leaps on this.
Well, here's I think what's another interesting chart and something I've been thinking about a lot right now. So on the screen we've got the S&P. We were just looking at this is a date range of, let's call it 5 months, a little bit more than 5 months, almost 6 months. And what we see on the very bottom is the S&P up 31%. This is essentially saying 31% since the bottom of the tariff tantrum that came to an end in early April. Since then, market's up 31%, right? Palantir since then is up 130%. Robinhood is up 264%. Now, I'm looking at those two stocks because they are stocks that we own, and this is not investment advice. This is just, these are two positions that we've had and they've done very well. And I'm looking at them and I'm looking at Robinhood being up, 250% in less than 6 months. And I'm thinking, that doesn't make sense,
No,
right? Like,
no.
so you're starting to see that type of froth and that type of activity in the market. And then you have people like famous hedge fund manager Ken Griffin coming out and saying this reminds him in some ways of the tech bubble, which we've heard a lot over the last couple of years versus or the AI bubble versus the tech bubble. And is this the same thing? What are your thoughts on that? I have a couple to share, but I'm curious to hear what you think about that.
Yeah, I mean, I think whenever someone sees a massive rise in the market so quickly, they're inevitably going to equate it to a bubble. And,
Mm-hmm.
with that being said, I'm sure that the people who are calling this a bubble are financially incentivized to do so. So I always take that with a grain of salt, especially when it's something like a fund manager or something like that. A lot of this is a ploy to buy into their particular funds. There are similarities to it, admittedly. There are a lot of companies out there right now that have had huge runs that do look similar to other companies in the dot-com bubbles. But just like at its core, if you look at profitability, like Cisco, for example, was trading at 31 times sales at the peak. And
Mm-hmm.
many peers, in comparison to that time, had literally zero earnings whatsoever. But if you look at today, like Nvidia is a perfect example of that, it's actually throwing off massive profits. So I think something that's a little bit different now is that while companies before were super elevated, not many of them had positive earnings. Now we actually have these companies that are huge and have huge market shares, but they actually have cash on hand and actually have earnings, which is a huge distinction.
Yeah, I think you're right. And when we think about the number of unprofitable companies, the thing is, when we think about the tech bubble, the tech sector was still fairly young and immature at that point. The Nasdaq, which tracks a lot of these high growth names, was a pretty new index compared to the S&P. When you look at this on the screen, you can see the bubble playing out, right? This is, and I'm going to just back this up a little bit and say, here's what the bubble looked like. So from this early, this is 1999, I think, right here. This is when we have in this Nasdaq bubble. So essentially, in a year, you got a double on the return on the Nasdaq, right? In the S&P, now the Nasdaq is the orange line, the S&P is this purple line. You didn't have anything like that type of an irrational enthusiasm, right? It was just
No,
one area of the market. It was a part of the market. And then when you look at the percent off the high here, and I'm going to go back to 1999, you can see that the S&P didn't really go down that much during the tech bubble. It was a bear market, maybe, I guess, by some accounts, but I don't even see it going below 20% here, right?
no.
So it was really the tech sector. Now, obviously, the tech sector has become a much larger part of the S&P 500. That doesn't mean that if this is a bubble, and I think it probably is, I don't know when it pops, but I think it is a bubble, but that doesn't mean the entire market goes down like a financial crisis just because of AI. There would have to be other components at play.
Yeah, I mean, when you think about the S&P 500, certainly it's very heavily weighted in tech right now, but there are many other sectors that play a big role. Something to keep in mind when it comes to comparing the tech bubble to, ultimately what we have now is you had all of these companies that ran up with these valuations and people put huge premiums on them. And then ultimately they sold off because no one was using them. And I think what's going to be really interesting, and I think this will kind of determine in the future whether or not we're in a bubble, is utilization of these companies. I mean, we're doing a ton of spending on things like utilities and the build out of the AI network. So for us, it's like as we think through it, if you're going to put CapEx or capital expenditure at a point where you're sinking a ton of money into AI, what's going to determine whether or not it's going to be a bubble is if you're actually going to end up using the AI and if it's going to have the impact that people say that it's going to have. If you put trillions of dollars into AI and building out an infrastructure that no one's ever going to use, then yeah, the bottom could fall out. But it seems like AI is becoming very sticky and the adoption rates are unbelievably high at the moment. If you just look at ChatGPT versus the internet in general, the adoption rate is the fastest of almost any company that's ever come out in history.
Yeah, well, that's true. And I think that saying that this is a bubble doesn't mean that AI is not going to be a useful tool and increase
Right.
productivity and increase profitability, et cetera. It just means that we're putting too much in it too soon, or we have too much enthusiasm. We get ahead of ourselves. The market always gets ahead of itself in one way or the other. And if you look at the companies like the tech bubble, for example, if you look at that, you can see that there were those companies like Apple and Microsoft. There were also companies like pets.com. And there's a difference between a profitable company and a company that's trading on ether. It's not trading on anything really at all. It's just trading on hopes and dreams. Those companies shouldn't be trading up to the moon right now if you think it's a long-term investment. I think people are maybe trying to make a get rich quick move with some of these stocks. And in reality, if they're working with profitable companies and holding on for the long run, they're probably going to be okay.
Yeah, 100%. And I think that that's what this comes down to. Everybody always says diversification. But if you're putting all of your eggs in a basket of super highly appreciating stocks that are trading off of, I'll say, very high earnings or no earnings, then ultimately it's very possible that something might not work out very well. But at the end of the day, there are a lot of companies out there that have good ratios, that are profitable, that are, working and doing the right things. If you invest in companies that are having those fundamentals, then you're probably going to be all right long term.
Yeah, yeah. It'd be risk aware, not risk averse, right?
Right. Yeah, 100%.
All right. Well,
Cool.
let's.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.